The market has continued to bleed over the last month, and just a few days ago, the Federal Reserve Chair, Jerome Powell, just issued his starkest warning yet on the potential economic consequences from tariffs. Now, keep in mind, year to date, the S&P 500 is already down 10% just through the last 4 months. And so while most businesses have yet to feel the effects of tariffs, this has pushed the market into extreme fear territory. Now, what's interesting is in the midst of all this chaos, Goldman Sachs released what they believe is their top European stock with total return potential of 91% in the next 12 months. And I want to take a much closer look at this pick. But first, let's go ahead and see what Jerome Powell had to say about tariffs, because tariffs could certainly play a major role for the stock that Goldman Sachs picked.
Despite heightened uncertainty and downside risks, the U.S. economy is still in a solid position. Surveys of households and businesses report a sharp decline in sentiment and elevated uncertainty about the outlook, largely reflecting trade policy concerns. Looking forward, the new administration is in the process of implementing substantial policy changes in 4 distinct areas: trade, immigration, fiscal policy, and regulation. These policies are still evolving, and their effects on the economy remain highly uncertain. As we learn more, we will continue to update our assessment. The level of tariff increases announced so far is significantly larger than anticipated, and the same is likely to be true of the economic effects, which will include higher inflation and slower growth. Both survey and market-based measures of near-term inflation expectations have moved up significantly, with survey participants pointing to tariffs. Survey measures of longer-term inflation expectations, for the most part, appear to remain well anchored as well. Market-based break-evens continue to run close to 2%. So, as we gain a better understanding of the policy changes, we'll have a better sense of the implications for the economy and hence for monetary policy. Tariffs are highly likely to generate at least a temporary rise in inflation. The inflationary effects could also be more persistent. Avoiding that outcome will depend on the size of the effects, on how long it takes for them to pass through fully to prices, and ultimately on keeping longer-term inflation expectations well anchored.
So Jerome Powell, based off the data he's seeing, does believe that the US economy is strong right now, but the tariffs are certainly going to have consequences, and we could potentially see a spike in inflation. Now, we'll need to keep all that in mind as we analyze Goldman Sachs' top European stock. And their top stock was NVO Novo Nordisk, and if you're looking at the actual stock ticker, you can see it's going to be NOVO-B.co. This is because it's on a European exchange. Now, Goldman Sachs published this report on March 28th, so just a couple of weeks ago, and again, they were saying there's 91% upside for Novo Nordisk. Now, if we look at the stock over the last year, it's been absolutely hammered, down almost 53%. And just look at that 52-week range. At its high, $148. At its low, $57.29. So a huge sell-off over the last year, and the stock is truly right at its 52-week low. Along with this, if we look at the dividend metrics, the starting dividend yield is about 3.63%, and it does have a history of growing those dividend payments. The payments do fluctuate a little bit, but that's pretty typical for European stocks. And like always, if you'd like to be able to download any of my spreadsheets and also get access to the ticker data add-on on Google Sheets that allows you to automatically import stock financials straight into your spreadsheet, then you can head over to tickerdata.com at the link in the description. Ticker Data is actually running a 1-week tariff sale where you can get 30% off any of the yearly plans by using code TARIFF at checkout. Now, if you aren't really familiar with NVO, they're really known for one thing, and that's diabetes care. And just a little while ago, they announced the release of what many were calling their miracle weight loss drug, Ozempic. If we look at the company's annual report, they state Ozempic sales uptake further strengthens our leadership in diabetes care. And if we zoom in and take an even closer look at the fine print, this is a drug that's administered as a once-weekly injection for the treatment of type 2 diabetes. Ozempic maintains its position as the world's biggest selling diabetes medicine, backed by its proven efficacy in controlling blood sugar and reducing body weight. Now, as we look at this statement through the lens of an investor, here's what we really need to pay attention to. Administered as a once-weekly injection. Another way of saying that is recurring revenue, predictable cash flows. The people who take this drug come to get it on a weekly basis. This creates a very sticky customer behavior. This is one of the key selling points for the stock. And in fact, if we go ahead and jump over to my profitability spreadsheet and plug in NVO, what do you notice? Look at that 5-year revenue CAGR, 19%. The 5-year net income CAGR, above 20%. And look at those gross profit ratios. The 10-year average gross profit ratio at 84.1%. Last year's coming in at 84.67%. And earnings in 2023 at $9.34. In 2024, it grew to $22.68. So it's easy to see why investors got excited about this stock, and in a short amount of time, we can see in mid-2022, it was trading around $50 per share, and just a couple years later got all the way up to about $148 per share, so almost a 3x. But as we already know, the sell-off in the last year has been significant. So what's going on with this stock? Well, let's start off in the last week or so, we saw a huge sell-off of European pharma stocks as President Trump reiterated his tariff plans. Now, we don't know exactly what this will look like for the stock yet, but it's obviously not great news. But with that being said, that's not actually the worst news for NVO in the last few days. Ironically enough, as I was researching this stock, I found 5 key risks, and coming in at number 1 was competitive pressure, especially from Eli Lilly. And what we need to know about Eli Lilly is they currently have 2 drugs that are in the obesity markets, and they are gaining market share. And what we just found out the other day is one of their key drugs in this market just succeeded in its phase 3 trial. Now, what does this mean? Well, we have to remember with pharmaceutical stocks, the future growth of these companies is always about what's in their pipeline. What are the new drugs they're going to be releasing that's going to help grow their earnings? And these drugs that they release have to go through multiple tests before they can hit the market. And there's 4 different phases. And so Eli Lilly's key drug just passed phase 3. So this is very close to being able to be released into the market. And so the result of this successful trial is Eli Lilly shares climbed around 14% in a single day. Meanwhile, NVO fell by over 7.6% on the day. So this was a huge hit to Novo Nordisk. And in fact, if we now look at them in just the last month alone, they're down over 27%. And in fact, we recently saw their stock get downgraded by BMO, and they slashed its target price to $64 all the way down from $105. And BMO's argument is that Novo Nordisk has lost its early lead in weight loss drug race to Eli Lilly. Now, let me show you what's so interesting about this. If we use the ticker data add-on in Google Sheets, we can pull in the estimated earnings per share average for NVO over the next few years. We'll use the ticker data function, select the stock ticker, select the metric we want, which is estimated EPS average, and then select the year 2025. What we can see is we get $28.37. That's the average estimated earnings per share. And if we go back and look at where they were in 2024, it was sitting at $22.68. So on average, they're still projecting pretty significant growth. And in fact, if we just drag this formula down, what we can see is there's still significant growth projected through 2029. In fact, the growth expected is still quite explosive, with the average estimate in 2029 coming in at $48.29. If we jump over to Seeking Alpha and look at their earnings estimates, what we can see is over the next 3 to 5 years, they're projecting 16.4% annual earnings growth. So growth projections for this stock are still pretty significant. So how did Goldman Sachs come up with 91% upside over the next year? Well, I think we have to look at this stock from a valuation perspective. To start off, when we're talking about a potential high growth company, but one that's in a pharmaceutical industry, there's 2 things we have to keep in mind. Predicting future free cash flows for pharmaceutical companies is extremely difficult, especially for the long term, because again, so much of it depends on what is in their pipeline. For example, in just a single day, it looks like Eli Lilly's pipeline got quite a bit stronger, so growth projections are likely higher. Along with this, there's also patent expirations that are always a risk to pharmaceutical stocks, and NVO is no different. For example, one of its key drugs loses its US patent in 2031. So anytime we either have a very high growth company or really a pharmaceutical stock, a lot of the times instead of a free cash flow analysis, it makes more sense to do a reverse discounted cash flow analysis, because this is going to tell us exactly how much growth the market is currently pricing into the stock. And you can see in this scenario, we're looking at the European version of the stock. And right now, the current share price is sitting at $421.25. And if we assume 0% free cash flow growth, the market would be valuing it at $194.31 per share. So what does this mean? The market expects free cash flow to grow, and so do I. But the question is, how much does it expect it to grow? Well, let's play with some numbers. If we bump it up to 5%, we can see reverse DCF price per share of 283. Let's bump it up quite a bit higher at 15%. All of a sudden, our reverse DCF is quite a bit higher than the current share price. So let's bring it down to around 10. All of a sudden we start getting very close to the current share price. And if we bump it up to about 10.38, we can see we get almost the exact current share price. So the market is telling us it expects Novo Nordisk to grow free cash flow over the next decade at a rate of about 10.38%. Now, if we think the free cash flow growth will be higher than that, then the stock is undervalued. But if it's going to be slower, then it's probably overvalued. But this starts to give us a baseline. The market is still expecting above 10% free cash flow growth, but that's still quite a bit lower than the average analyst expectation. Now let's look at this through the lens of a sensitivity analysis. What kind of return can we expect based on projected earnings growth and based on the projected future PE ratio for this stock? So two elements that we have to project, earnings and the future PE ratio. Let's start with the PE ratio. What can we learn about this stock? Well, the average PE ratio over the last 10 years for this stock is 27.31, but that doesn't really paint the whole picture. What we can see is 2016 through 2020, the PE ratio was ranging from around 17 on the low end to about 23 on the high end. Then from 2021 through 2024, it climbed significantly higher. This is because the release of Ozempic and some of their other obesity drugs caused earnings expectations to go quite a bit higher, meaning investors were willing to pay a much higher premium for the stock. So to start out, let's talk about an absolute best case scenario for this company. Let's say the PE ratio climbs all the way back up to the average 10-year PE ratio. So we'll go ahead and plug in 27.31. But now we need our projected earnings growth. Like we've already seen, the market is still pricing in above 10% free cash flow growth, and like we saw in Seeking Alpha, they're projecting above 16% earnings growth. And if we take the average analyst estimates from Ticker Data, growth is significant. So again, we're talking about a best case scenario, so let's go with about 17% projected EPS growth. What would the results be? Well, if we zoom in, here's what we can see. By the end of 2030, our total return would be 277%, which would be a compounded annual return of almost 25%. By 2027, the total return would be 135%. And at the end of 2025, this year, our total return would be 72%. Now, that 72% is still a decent bit lower than what Goldman Sachs is projecting over the next year, so it does look like they're being pretty aggressive with their projections for this stock. Now, let's be a little bit more realistic and a little bit more conservative with our projections. Maybe the stock gets about 11% earnings growth and the PE ratio climbs a little bit higher than we've seen over the last year or so. We'll say it gets to about 21. What we can see is our total return in 2030 is still 111%, which is a compounded annual return of 13.3%. So when we talk about this stock from a risk to reward ratio, we can see it's certainly starting to become quite a bit more attractive. In fact, if we just look at the annual report from this company, they're even projecting sales growth in 2025 to be about 16 to 24%. They also project operating profit growth to be between 19% and 27%. Now, I do want to quickly touch on the other key risk to this stock because we've already touched on number 1 and number 5, but number 2, we still have regulatory and political risk. The company heavily relies on US sales where drug pricing is under constant political scrutiny, and on top of this, we're starting to see the effects of tariffs. At number 3, we have manufacturing and supply constraints, and this is something the company completely acknowledges in their annual report. They stated that despite the sales penetration of Ozempic, high demand has also posed challenges, necessitating strategic decisions to prioritize distribution to regions and patient groups with the most pressing needs. We have also continued to invest heavily in expanding production capacity, seeking to stabilize supply and ensure that Ozempic remains accessible to the growing number of patients who have already initiated treatment. And then at number 4, we have product concentration risk, but to be fair, this is probably true for most pharmaceutical companies, but a huge percentage of NVO's revenue comes from a single molecule. So basically, if something came out stating that this molecule is not safe, that'd be pretty devastating for this stock. So when I look at the market as a whole right now, NVO probably has one of the most interesting risk to reward ratios out there. There's obviously huge potential for this stock, but in just the last few months, they have been hammered with negative news. And as we learned from Jerome Powell, it looks like tariffs are going to negatively impact this stock as well. So go ahead and let me know in the comments down below what you think of NVO stock. And again, like always, if you'd like to be able to automatically import stock financials straight into your spreadsheet, then you can head over to tickerdata.com. And right now, you can use code TARIFF to get 30% off any of the yearly plans. So with all that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.